In this video, I'm revealing a powerful 1-minute scalping strategy that's designed to help you trade like the pros. Here's what you'll learn. How to identify institutional zones in the market, the key areas where the big players make their moves. The institutional signal framework, a proven method to pinpoint high-probability trades with precision. Plus, I'll introduce my 3-concept trading approach, which includes the LRC framework, a simple yet effective way to read and predict market momentum. The emotion-free trading method, a mindset shift to eliminate hesitation, overtrading, and fear. If you're ready to master the art of scalping like the institutions do, hit that like button to show your support. And don't forget to subscribe for more strategies and insights that can transform your trading game. Let's get into it. Let's begin by exploring the foundation of this strategy. Supply and demand zones. These zones are the battlegrounds where institutions, often referred to as smart money, place their significant orders. Understanding these areas is essential because they reveal where the big players are making their moves, giving us a chance to align with their strategies. A supply zone is a price level where selling pressure dominates, preventing the price from moving higher. This often occurs after a strong rally or uptrend, as institutions or banks sell off to lock in profits, causing the market to reverse and drop. On the flip side, a demand zone is a price level where buying pressure takes over, halting further declines. These zones usually form after a downturn, where large players step in to buy, creating upward momentum and driving prices higher. By recognizing these zones, we can pinpoint the areas where the market is most likely to react, and that's where we want to focus our trading efforts. Not all supply and demand zones are created equal. Some are significantly stronger than others. From my experience, 4 key factors determine the strength of a zone. Let's break them down. Candle size of the move. The size of the candles tells a story. Large, consistent candles in one direction are the footprints of big institutions. These moves show that smart money is behind the action, creating high-probability zones. On the other hand, small candles, mixed colors, or candles filled with wicks often indicate weak or indecisive moves, making those zones less reliable. Always look for zones with clear, dominant candle patterns. The second factor is the freshness of the zone. The fresher the zone, the better. A zone that has never been tested holds the most strength and is ideal for your entries. When trading on lower time frames like the 5-minute chart, you'll encounter many zones, but prioritizing fresh ones is crucial. Once a zone has been tested, it loses its power. To maximize your success, focus only on untouched zones. One of the strongest indicators of a solid zone is a breakout of structure. A move that breaks key market levels, like previous highs or lows, is a clear sign that institutions are driving the market. These breakouts often trap retail traders and trigger stop-loss orders, creating a shift in market dynamics. When you spot a zone tied to a breakout of structure, it signals a high-probability trading opportunity backed by smart money. The final factor is the space between the zone and the next level of support or resistance. A strong zone creates a clear imbalance in the market, leaving a noticeable gap. This imbalance shows that institutions have driven the price action, leaving room for the market to react when it returns to the zone. Zones with minimal space or clutter around them often lack the momentum needed for a reliable trade. Now, let's dive into this real chart example. Here we see a demand zone forming. Let's break it down step by step to evaluate whether this is a high-quality zone or one we should avoid. First, take a look at the candles leading into the demand zone. Notice how we have large, strong candles moving consistently in the same direction? These candles, with little to no wicks, are a clear sign of institutional activity. They indicate significant buying power and volume, exactly what we're looking for in a high-probability zone. Weak candles with wicks or inconsistent movement wouldn't give us this level of confidence. Next, let's check the freshness of the zone. This demand zone has never been tested before, making it fresh and more likely to produce a strong reaction when the price returns to it. Remember, the first test of a zone is often the most reliable, as it retains the full strength of institutional orders. Zones that have already been tested lose their power and are better avoided. Now, consider the breakout of structure. Look closely, and you'll see that this move broke above a key resistance level, creating new highs. This breakout is a hallmark of institutional activity. It shows smart money stepping in to push the market higher, while trapping retail traders and triggering stop losses. This type of structural break further confirms the zone's strength. Finally, let's evaluate the space and imbalance created by this move. Notice how the price action has left a clear gap, with no significant levels of resistance between the demand zone and the next key level. This imbalance shows that institutions drove the price aggressively, leaving room for the market to react strongly when it revisits the zone. Zones with obvious space and a clean imbalance are ideal for high-probability trades. By analyzing the candle size, zone freshness, structural breakout, and imbalance, we can confidently determine that this demand zone is high quality and worth trading. These are the exact criteria that help us align with institutional strategies and maximize our edge in the market. Now, let's shift our focus to a tool that is often underestimated but incredibly powerful when used correctly: the institutional signal framework, specifically the MACD indicator. The MACD is made up of three key components: the MACD line, the signal line, the histogram. All of these components revolve around the zero line, which acts as the MACD's center and a key reference point for market momentum. Institutions build their trading systems around MACD crossovers. When the MACD line crosses above the signal line, this is called a bullish crossover, indicating the market may move upward. On the other hand, when the MACD line crosses below the signal line, it's a bearish crossover, signaling a potential market drop. This isn't just a coincidence. Institutional algorithms are meticulously built to recognize and act on these signals. Here's the exciting part. If you know how to spot and use these crossovers effectively, you can predict market direction before it even happens. Now we have two important pieces of information. Institutions use supply and demand zones to execute their orders. Institutional algorithms are designed to detect MACD crossovers and trade based on them. Now, let me give you an example to show how these two concepts come together in action. Look at this chart. Here's a clear supply zone. The candles are large and consistent, showing strong selling pressure. The move away from the zone is sharp and decisive, with no hesitation. The zone is fresh, being tested for the first time. The previous market structure is broken, signaling significant institutional involvement. There's clear space and imbalance between the supply zone and the next level, giving room for price movement. This is a textbook institutional supply zone, because institutions don't unload their entire position all at once. Instead, they distribute their orders in chunks, placing limit orders at the same price level to sell more if the market revisits the zone. This area represents a price level institutions find favorable for offloading their orders. So what happens when the market revisits this zone? It often faces strong resistance and drops. Now, let's integrate the MACD indicator for confirmation. As the market returns to this supply zone, notice how the MACD line crosses below the signal line. This bearish crossover is a signal institutional algorithms take seriously. It confirms a sell opportunity. Here's why this combination is so effective. We know where institutions sold previously and where their limit orders are likely placed to sell again. We have confirmation from the MACD, as its algorithms signal a bearish crossover at the same price level. What happens next? Look at the chart. The market reacts to the supply zone, respecting institutional orders, and moves downward. By combining supply zones with the MACD, you align your trades with the strategies institutions use, giving you an edge in the market. Now we have the core foundation of the strategy. Let's dive deeper into how it works. We'll use the 15-minute time frame as our higher time frame to identify supply and demand zones, and we'll trade these zones using MACD signals on the 1-minute chart. Let me show you an example using the XRP US dollar 15-minute chart. Here's a clear demand zone identified on the chart. Let's evaluate it to ensure it meets the criteria for a high-quality zone. Large candles indicate strong buying pressure. The move away from the zone is quick and decisive, showing no hesitation. The zone is fresh, being tested for the first time. The previous structure has been broken, a clear sign of institutional involvement. There's noticeable space between the demand zone and the next level, giving the market room to move. Based on these factors, this is a solid institutional demand zone. Now let's switch to the 1-minute chart, where the 15-minute demand zone is plotted. At this point, we're waiting for the market to reach this zone. When the price touches the demand zone, we need a reaction, a candlestick signal like a rejection or reversal. But that's not enough. To confirm the trade, we also need a bullish MACD crossover. Here's what happened. The market touches the demand zone and forms an engulfing candlestick, indicating buying pressure. However, the MACD line hasn't crossed above the signal line yet, so we wait. Remember, the MACD crossover is crucial. It confirms that institutional algorithms are likely to join the move upward. Shortly after, the MACD line crosses above the signal line, confirming our buy entry. Now, let me show you how to take this trade. Enter at the close of the candle that forms after the MACD crossover. Place your stop loss 5 pips below the 15-minute demand zone to give the trade sufficient breathing room. Set your target using a 1.5 to 1 reward to risk ratio. Your target should be 1.5 times your risk. As you can see, the market moves upward and hits the target, making this a successful trade. To replicate this strategy effectively, follow these steps. Location. Identify a high-quality supply or demand zone on the 15-minute chart. Reaction. Wait for the market to react positively when it reaches the zone, such as forming a candlestick rejection or reversal. Confirmation. Use the MACD crossover as the final confirmation that institutional algorithms are likely joining the trade. This approach ensures your trades align with institutional strategies, giving you a stronger edge in the market. Let me give you another example. On the 15-minute chart, we've identified a supply zone. This is our location. Let's assess it to ensure it qualifies as a high-quality trading zone. Significant candles suggest strong selling momentum, highlighting the presence of institutional activity. The price departs the zone sharply and decisively, showing no hesitation. The zone is fresh, meaning it's being tested for the first time, which often leads to stronger reactions. A prior market structure has been broken, further confirming that institutions are driving the price. There's a clear gap between this supply zone and the next major level, providing room for price movement. These factors confirm that this is a solid institutional supply zone. Now, let's move to the 1-minute chart, where the 15-minute supply zone is plotted. Here, we're waiting for the market to approach this zone and observing how it reacts. Here's what happens. The market enters the supply zone and immediately gets rejected, forming a tailed bar, a sign of strong selling pressure. Shortly after, a doji candlestick forms, signaling indecision and a potential reversal. However, the MACD indicator hasn't confirmed the trade setup yet. The MACD line has not crossed below the signal line, so we wait. This confirmation is crucial because it signals the entry of institutional algorithms, which increases the likelihood of the trade moving in our favor. Now, look at what happens next. The MACD line crosses below the signal line, signaling that institutional algorithms are active in the market. This crossover gives us the green light to enter the trade with confidence. Here's how to trade this setup effectively. Enter the trade at the close of the confirmation candle that forms after the MACD crossover. Place your stop loss 5 pips above the 15-minute supply zone to minimize risk while giving the trade room to breathe. Aim for a 1.5 to 1 reward to risk ratio, where your target is 1.5 times your initial risk. Look at what happened. The market moved exactly as anticipated and hit the target. This method is all about precision, identifying high probability setups and confirming them with tools like the MACD to ensure you're trading with, not against the big players in the market. Okay, let me share an important note with you. We backtested this strategy, and it has a 73% win rate. Even in a worst-case scenario, where your win rate drops to 42%, you can still remain profitable. This is possible because of the 1.5 to 1 reward to risk ratio, which ensures your winners outshine your losers. That's the power of a well-structured trading plan. Let me share with you a trading approach that can save you from a lot of stress, especially when working with the 1-minute time frame. It's called the set and forget approach, and trust me, it's a game changer. Here's how it works. On the 15-minute chart, I identify a high probability supply zone, a strong area where I anticipate the market will react and reverse. From there, I switch to the 1-minute chart, patiently waiting for the market to reach the zone. The market touches the supply zone and gets rejected, confirming it as a valid level. Shortly after, I spot a bearish MACD crossover, providing the confirmation I need for the trade setup. At this point, I set my entry, stop loss, and target, and then I do something most traders struggle with. I step away. Yes, I actually walk away, I grab a coffee, take a break, or focus on something else entirely. I trust the process and let the market play out. If the trade works, it hits my target, and I lock in profits. If it doesn't, it hits my stop loss. And that's okay. I move on to the next setup without overthinking it. Let me share an example of what can go wrong when you don't follow the set and forget principle. You spot a great demand zone on the 15-minute chart, switch to the 1-minute chart, and notice a clear rejection along with a bullish MACD crossover. Confident in your setup, you place your entry, stop loss, and target. But instead of stepping away, you stay glued to the screen, anxiously watching every tick. The market starts moving against you, creeping closer to your stop loss. Now, instead of letting the trade play out as planned, you make a critical mistake. You move your stop loss further away, refusing to accept the loss. The market continues moving against you, and you move the stop again. Eventually, the market wipes out a significant portion of your account, all because you couldn't let go. If you had simply followed your plan, the loss would have been small, manageable, and just part of the process. You'd have been ready for the next trade with a clear mind. But by letting emotions take over, you turned a single loss into a much bigger problem, proving why discipline and emotional control are non-negotiable in trading. The beauty of the set and forget approach is that it removes the emotional chaos from your trading. By stepping away from the screen, you avoid overthinking and second-guessing your setup. You stick to your plan without interfering. You save yourself from the stress and mistakes that come with emotional decision-making. We've reached the end of this video. If you found this strategy valuable, hit like and subscribe for more insights to elevate your trading game. Got questions or thoughts? Share them in the comments. I'd love to hear from you. Until next time, stay disciplined and trade smart.